Welcome! You're viewing the Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart for November 29th, 2015. Market breadth. With this past week's market fractional advance, our Bull Bear Point and Figure ratio at 0.96 rose from 0.81 last week, yet remaining in bearish territory. The total count of securities in bullish or bearish patterns rose fractionally to 2,869. The count of bearish stocks decreased 7%, while the count of stocks in bullish patterns increased 10%. The Pirls PNF Market Breadth Summary Chart shows us a market now 26 consecutive weeks in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To obtain a free subscription via email to the Pirls Stock Market Commentary, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 111 points for the ninth advance in 13 weeks. At a negative 33.91 points, it continues below all 7 tops above plus 100 and continues above all 5 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 0 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. At a positive 71.51, the CCI 20 daily has increased from positive 58.31 last week, and at Wednesday 11/25 close formed a zero-line reject long entry point within the plus or minus 50 range. We will follow the results of this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend this past week, while the daily CCI 20 began a Woody's uptrend 6 weeks ago. The CCI 20 weekly now has 6 consecutive days above 0, ending the Woody's downtrend and our short trade simulation following a zero-line reject short entry point 2 weeks ago. It rose again this week from positive 52.36 to positive 74.67, moving against our trade. The result of this trade simulation will be determined at Monday 11:30 open and reported in next week's commentary. Industry rotation the last 2 weeks. All of the top industries are positive and 3 of the bottom industries are negative. Bullish, S&P Retail has entered and leads the top 5. Networkers and semis have entered the top 5. REITs continues in the top 5. Gold and silver continues in the bottom 5. Oil services continues in the bottom 5. Computer hardware has left the bottom 5. Bearish, disk drives continues to lead the bottom 5. Focus this week from www.dollarcollapse.com. Chinese debt snowball gaining momentum. The following are some key points. Financial crises can happen quickly, like the bursting of the tech stock bubble in early 2000, or slowly, like the late 1980s junk bond bust. The shape of the crash depends mostly on the asset in question. Equities can plunge literally overnight, while bonds and bank loans can take a while to reach critical mass. China's bursting bubble is of the second type. During its post-2009 infrastructure binge, trillions of dollars were lent to producers of cement, steel, chemicals, and other basic industrial inputs. And now a growing number of them can't make their payments. What happens next? In the standard script, defaults begin to snowball as companies unable to pay off their bonds, bank loans, and supplier bills cause their creditors to either fail or scale back lending, which impairs other leveraged companies, and so on, until things get out of hand. Then, the government either steps in and tries to bail out what's left of the market, or stands aside and allows the bad debt to liquidate. In actual capitalist societies, option number 2 is how unwise loans and malinvestment are liquidated to return the system to health. But lately, everyone has been choosing option number 1, which means socializing the private sector's debt by recapitalizing banks and borrowers with taxpayer funds. This averts a crisis in the moment, while setting the table for an even bigger mess in the future. It's a safe bet that China, following the developed world's lead, will soon toss a big chunk of its foreign exchange reserves at the problem. When this fails, the next steps include QE and negative interest rates, which take money from savers and retirees and give it to banks, again with the hope of moving the inevitable crash to some later date. The result? An even more highly leveraged world and Potemkin markets that look real, but no longer are. Thank you for tuning in for this week's Santu Pirls Stock Market Commentary, featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping you had an enjoyable Thanksgiving holiday, that you're enjoying a pleasant and peaceful day off today, that you're looking forward to a productive and prosperous week coming up, and wishing you true success.